This video focuses on the closing process from Chapter 4. To close means to bring accounts to zero, to bring their balances to zero. There are 4 steps in the closing process, and you can remember them with the acronym REID, R-E-I-D. The first step closes revenues. The second step closes expenses. The third step closes income summary. And the last step closes drawing. Since we want to bring our revenue account, fees earned, balance to zero, we would debit fees earned and then credit an account called income summary. Fees earned has a normal credit balance, or it increases on its credit side. That's why we are debiting fees earned in order to bring it to zero. The income summary account is simply a clearing account that's used to summarize income. The next step in the closing process is to bring all of the expenses to zero. In order to do this, you're going to need to credit each expense account individually and then debit income summary for the total of all expenses. The third step in the closing process closes income summary. And you can see from my slide, I'm telling you that you'll either debit or credit income summary, and you'll either debit or credit the capital account. The reason I can't tell you specifically is because this one will be dependent upon whether or not you have net income or net loss. The dollar amount of this journal entry represents net income or net loss, depending on what it is you have. And the last step in the closing process is to close drawing. So drawing normally gets bigger by debits. So if we want to bring drawing to zero, we're going to need to credit it. And since we've now closed out income summary, we did that in the third step, we close drawing to capital. The other reason we don't use income summary when we close drawing is because drawing doesn't have anything to do with net income or net loss. So which accounts get closed? The red ones: revenue, expense, and drawing. All accounts are either temporary or they're permanent. If they're temporary, that means they get closed. If they're permanent, that means they do not get closed. So again, the temporary accounts, or the ones that get closed, are the red ones. The permanent accounts are asset, liability, and owner's equity. A post-closing trial balance is completed after the closing entries, and the purpose of the post-closing trial balance is to make sure that your debits still equal your credits now that the closing process has been completed. Since a post-closing trial balance is done after closing, then the only accounts that are going to be found on the post-closing trial balance are the permanent ones: assets, liabilities, and owner's equity. Remember, the temporary ones, the red ones, revenue, expense, and drawing, have all been brought to zero.